The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, as we wrap up the weekend, the market trade, we see a bit weaker action going on in the grains. Livestock holding on to some green to round out the week, and then we have plenty going on in the outside markets between the jobs report, the stock market bouncing around. Crude oil's had an interesting week. Here to talk about things with us and give us his perspective, Ted Seifried, Zaner Ag Hedge, is with us here today. Ted, always good to talk with you, buddy. How are you?
I'm doing great, Jesse. Thanks for having me. Always a pleasure.
Well, Ted, let's see what rabbit hole we can go down here today when it comes to commodities. You laugh with me a little bit there. There's a lot going on. Grains, seasonal harvest tendencies, demand is poor. So I guess, for starters, what's your overall take of just how the grain trade has looked here this week, Ted?
Yeah, so harvest is kind of going along at a normal pace. It's not really faster than expected, although I think it could have been if we had really missed out on a lot of these rains, because you had a lot of crops pushing to maturity maybe a little bit earlier than usual. But we've had some rain delays, so we're kind of very average pace of harvest really. So, as far as harvest pressure rolling in, I mean, we all want to say, oh, that's done, now we're past it. I don't think we're quite there yet. For one, I've got a number of guys that are finding more bushels than what they were expecting. So those were unaccounted for, unmarketed, yet to be sold, right?
Mm-hmm.
And on top of that, go back to a week ago, a quarterly grain stocks report that showed on-farm storage up 19% year over year in corn and up 14% year over year in soybeans, meaning there's a lot of, as far as what the USDA has to say, I've got a lot of people arguing with me on this one. Look, these are the numbers that we have, right? But theoretically, there's a lot more grain that's been stored on farm that, well, that means less room in bins. That means more grain, one way or another, has to come to town, right? Whether it's old crop, new crop, off the combine, previously sold, okay, fine. But that suggests to me that harvest lows might come a little bit later than normal this year because of the amount of on-farm, and for the fact that we are at a normal pace of harvests, and for the fact that some of us are finding a little bit of extra bushels. So all those things together, like I said, I'm not so sure that all the harvest pressure is over. Now, the question is, are the harvest lows in? Now, those don't necessarily have to be the same thing, Jesse, because if you have something else that's offsetting the harvest pressure, i.e. fund short covering, for example, well, then we can have harvest lows in even though we aren't done with harvest pressure. What that would mean, though, in that case, is that the harvest rally or the post-harvest rally that we might enjoy might not be as good because a lot of that fund short covering is being absorbed by the current pressure, which we might not bounce as high. So I don't know which one's better. I don't know if it's better to say, yay, the harvest lows are in, but we're not going to get a tremendous bounce because the overall fundamentals haven't turned all that much more bullish, or to say, yeah, the harvest lows aren't quite in, but we could see a fairly significant short covering rally or bounce into the end of the calendar year. Again, I don't know which one's better.
Something you said there, it makes me think about something to pose to you, Ted. Instead of one big giant post-harvest rally, does it feel like the market could maybe set us up for a couple small short covering rallies like we saw here this week in the corn market?
Yeah. So, Jesse, Thursday was kind of a big deal for the markets, right? We had started hearing rumors a little after 10 o'clock, right around 10:30, that there was a container ship, general container ship on the way to Port of Danube that had struck a mine. And that caused a significant amount of short covering, because anytime something like that happens, we have uncertainty over, wait, how bad is this? What's the reaction going to be? What's the retaliation? What are the insurance companies going to do as far as insuring vessels and insuring their cargo? This would be an absolute terrible time for insurance companies to say, you know what, this is too much risk. We're not going to continue to do this because Ukraine's on the same schedule we are as far as harvest is concerned. They're going to have a tremendous amount of new crop. They're going to have to move. 2 months ago, this wasn't as big of a deal. Now, heading into harvest, or they're progressing along in their harvest. Wow, to shut down their ports now would be, well, it'd be bad for them, super bad for them, especially since their neighbors have said we can't take any more Ukrainian grain. It's killing our domestic markets and our domestic farmers. But it would be bad for the overall global trade. From the standpoint, that would just be lost, right? So that was the nervousness that we had yesterday. That's where that short covering came from. It got corn up and over some very key resistance levels that it had been struggling with for the previous 4 trade sessions. And it was great. I was kind of saying, okay, here we go. These are technical traders, and this is now a technical buy signal. And we didn't wipe that off the map on Friday. But we didn't get that big bullish follow through that I think a lot of people were hoping for. So, to your point, this could be fits and starts. Unless there is a game-changing fundamental that is a lasting change in the markets, it's kind of going to be, I think, difficult to get the funds to continue to cover. We could have days like we did on Thursday, but I don't know if this is going to be an overall trend. The other thing too is, as we talked about, when you have a spike like that on Friday or on a Thursday, and then you don't have this follow through short covering happening on Friday, you do get an influx of that harvest pressure that producer selling, saying, hey, we just had a 10-cent rally. I'm going to reward the market. I'm going to take that. A lot of it's maybe HTAs and because basis did not do good things yesterday. So yes, you're going to have both sides of this equation. It's going to be kind of a bit of a tug of war, and where we end up a week or two from now, I think really depends on what's happening in the overall economy. I think there's macros at play that we need to be paying a bit of attention to. Generally speaking, we say, especially this time of year, we're really focused on individual fundamentals of grain markets and things like that. Mm-hmm. But when you have extremes, like, we've had an extreme rally in the US dollar since the middle of July. We've had a fairly extreme drop off in the stock market, since the end of August. Yep. You have a lot of people talking recession and a cold winter, a slowdown going into fall and winter. If that does come to fruition, Jesse, and we're talking deflation, things like that, I think that I'll have a big underlying current for the commodity markets and grain markets in particular. Well, grain, livestock, agriculture markets in particular. And that could very well influence what the funds do, how willing they are to cover shorts. And if they're not super willing to cover shorts, if we don't continue to give them reasons to do so, well, then harvest pressures, I mean, that means maybe the harvest lows aren't in yet, right? And so I'm not convinced that they are. I really am not. Again, I look at the overall economy and I have concerns there. I will say this: Friday was a good day. Reversal higher in stock markets, continued pressure on the dollar, although the dollar hasn't broken any key support points and still maintains this very well organized upward trending channel that it's been in since July. And by the way, that means traditional technical analysis would say that this is not yet a mature or old aging bull market in the dollar. So that's a concern, right? But the reversal higher in the stocks, I think, is the main friendly thing that we had there on Friday. Maybe that's saying near-term lows. Maybe that'll ease some of the fears for now. Maybe that'll change the fund's tone of really wanting or needing to be short commodities, and maybe that does allow them to cover some shorts. But the thing, again, go back to the short covering rally we saw on Thursday. They didn't continue that on Friday, and that's a concern for me. If anything, I feel like they kind of put some of those shorts back on. In light of having big technical, really just corn, beans and wheat didn't quite do it, but you had a pretty solid buy signal from a technical standpoint in corn at the end of the day on Thursday. And for the fact they didn't follow through on Friday, that's a bit of a concern for me.
We're having a conversation today with Ted Seifried from Zaner Ag Hedge. And Ted, kind of continuing on the grains here real quick, and the economic side of that, I know treasury yields have been a big talking point as well, tied up with the dollar, et cetera. That jobs report that was out Friday morning was hotter than expected. I know that was some of the initial pressure, I think, of the stocks before we rallied. But to your point as well, tied up with all this in grains, is it more advantageous for someone to sell corn or beans off the combine? Because to your point, something's got to go to town. So what's the better one, corn or beans at this point?
Yeah, real quick on that jobs report. The other thing is that we had a revision higher for July as well. So
Yeah. Yep.
that's a lot of bullish numbers from a jobs report. Kind of headed into November. Interesting. Also, the concern that we initially had on that, and we shrugged it off, but the concern that we initially had on that is that, hey, that maybe opens the door for more rate hikes. Oh, that's a double-edged sword there, Jesse. Anywho, to your question, which is a very good question. I think this, right? We're looking at interest rates kind of the highest they've been in sort of 23 years when we're talking about, loans and things like that. So I think what we need to be doing is whatever brings us the most cash in the shortest amount of time so that we can pay down loans and get out from under interest rates is sort of what I think we would need to do. And for me, that's soybeans, right? Soybeans are still at a relatively good price. I know people want to say, yeah, but that soybean balance sheet's really tight. And if we get more demand coming in, it could get tighter and soybeans can go to the moon. So I want to store them, and that's fine. But there's other ways of participating in upside potential for soybeans, i.e. call options, go out to July. You can do something there. But you're still getting, relatively speaking, some good prices for soybeans, Jesse. I think you need to really take a look at that. And again, you can convert soybeans into bigger amounts of cash quicker, just in the nature of dollars per bushel and so on and so forth. So for me, it's sell soybeans, maybe store corn. The corn outlook's quite a bit more negative than soybeans, and that all started with the bigger acres. But then on top of that, we've really had a struggle with our export sales on corn. They've picked up recently. Ethanol profit margins are good, but also unleaded gas demand is not great. So that means that the ethanol companies are going to be profitable. It doesn't necessarily mean that they're going to grind more. So I think corn is the one that could potentially have a better story down the road than what we're looking at or sitting on today. The soybeans are the ones that could have a potentially worse story than what we're sitting on today. So for me, I've got multiple reasons to sell soybeans at harvest and maybe store corn if I can. But I really don't mind the idea of re-owning the soybeans on the board using call options just in case we get into June, July, and there's been a problem with the South American crop, and now China is short on beans, and here we go. Like, things could go crazy. So you want to have that. You want to have an eye on that. But in my mind, there's a lot more downside risk in soybeans right now. You can get more bang for your buck as bringing in cash on a shorter period of time for soybeans right now. And like I said, the name of the game for me is paying off those loans.
Ted, let's talk about our friend liquid gold crude oil. Just a couple weeks ago, there was talk of $150 a barrel crude oil, and now we're at 82. So your take on what's going on in crude, is it a demand concern? I mean, is it something else? I'm seeing, thinking about gasoline demand and more. Europe's gas stocks are at a record high going into the winter months. I mean, reports I'm seeing on that anyway. It's just, what's going on in crude? What's with the big reversal? Is this a case of funds just getting out of this market, or what am I missing here, Ted?
Yeah, it's funny, Jesse, when everybody gets to their like bullish fever pitch in a market like crude oil, when we've done what we have done, and we start calling for 150, and I say we facetiously, that's when the break comes, right? And it's sort of, you look back at that and you're like, it's very textbook, I guess. But yeah, what's changed in crude? I don't think a whole lot. To your point, yes, there's been a lot of fear on the demand side of the equation, not just on crude oil, but really commodities as a whole. I'm going to tie that in later when we talk about cattle and beef. There's been a lot of concern about the supply or the demand side of the situation. Nothing's really changed on the supply side of the situation. So now it really depends on, okay, what are we going to do? Are we going to accelerate this move downward in the stock market? Or is the dollar going to continue to do what it's doing? Are we going to see interest rates continue to go higher despite the Fed maybe continuing to pause? They've kind of taken on a life of their own now. Are we heading into this, dark, cold winter financially, right? And if that's the case, then there's still more downside potential. But I honestly think that crude finds some footing here, at least in the shorter term, and has a bounce back. I think we've overdone it to the downside, which happens in a bull market. And when you've been going higher for so long and your speculators are all bulled up, wound up, they're week longs and they go running through the doors, right? So again, I don't think the overall fundamental picture for crude oil has changed unless we get into a deeper, darker recession. The supply side of this situation, in my view, is enough to look to buy a dip in crude oil, especially for producers that have been sitting here thinking like, wow, my energy needs are just kind of getting out of hand right now. If you needed a second opportunity to do some hedging or make some purchases, I think this is it.
Ted, let's wrap up on livestock. You alluded to cattle and beef, and let's tie this all together. I know, especially this cattle market, a lot of folks wondering, is this a correction? Is the top in? What's going on here in cattle? So tie this together for us. What are you seeing in the cattle trade, Ted?
I really feel like when we're talking about crude oil, we're talking about cattle. These are very, very similar markets in the sense that they have a supply side bullish outlook and have for quite some time. They've been in longer term rallies, and they get spooked when we have demand fears based on commodity or economy concerns. I mean, you have a whole lot of very, very serious parallels between cattle and crude. In fact, if you overlay those two charts, especially since May, there's a lot of very similar things going on there. So yeah, again, it comes down to the exact same conversation we just had. We've had demand concerns recently, which is why we've broken off the highs. The short supply situation has not alleviated itself and doesn't look to be doing so anytime in the near future. So it really is just a question of what is demand going to look like going forward? Are we going into this bigger recession, and so on and so forth? On Friday, you had that reversal higher in cattle, which looked really good, bouncing off trendline support, really solid, right? And so that, I think, very much ties into that reversal higher that we had in stocks. You get this, you lose some of that fear and you find some buying in cattle markets. Surprise, surprise. Now, where do we go from here? Well, this is the time of year where we expect box beef prices to kind of find a near-term bottom. It's been a struggle to do that this week so far. I'm optimistic that happens. I'm optimistic that this was just a correction. But again, you got to keep your ear to the ground as far as what's going on in the overall economy. I think you got to have a chart of the stock market up, pretty much at all times. Keep an eye on that dollar too. So there's a lot of macros at play in the cattle market right now. And then feeders are the ones that have taken the brunt, right?
Yeah.
The idea there is that, packers know with the tight animal supply, and with box beef prices having a hard time finding that low, their best bet is to slow down production, right? And so they're going to try to hold back on buying, which is going to put pressure on the cash market. We've seen that in the last couple of weeks. And that longer term puts a lot of pressure on the feeder market. So, yeah, it was good to see the feeders find some footing there. Hopefully that was it for the correction. It was a very violent one. Spanned a little right around 3 weeks, let's say. Hopefully this was it for now. We'll see. But like I said, when you talk cattle, you have to talk overall economy and what's going to happen with demand going forward.
Ted, final thoughts for us real quick. Anything you want to mention or reiterate to folks today?
Wow, we've covered a lot of ground, Jesse. I'm not exactly sure what we've missed.
We picked a rabbit hole and we went down it, that's for sure.
The one thing I will say is that I am not saying that we are headed for a recession. In fact, the amount of people that are calling for it kind of make me feel like we might not be. But if we do, Jesse, I think hogs are a very interesting place to maybe hedge against something like that. Because if we're going to give people a real hard decision to make when it comes to spending bigger money or higher price, spending money on higher price beef, if we're tightening the belt, the lower price cuts of pork might be the ticket. You might find more demand on a recessionary type environment for pork. And if that's the case, then all of a sudden we might have a tight supply situation in hogs. So I don't know. For me, if I'm looking to hedge against the recession or things like that, I think hogs are an interesting bet. That being said, if we don't go into a recession and with all the issue with the California situation, man, it's hard to be bullish those back month hogs. But we'll see.
Definitely. Ted, if folks have questions for you, they want to reach out to you there at Zaner Ag Hedge, how could they reach you, Ted?
Sure, absolutely. You can reach me directly at 312-277-0113. You can find us on the web at www.zaner.com. We're also doing an afternoon, just 5 to 7 minute quick commentary on markets. It's me doing that. So if you want to hear what I'm thinking kind of every day, you can sign up for that, and it's a hotline. And aside from that, I'm on the Twitters or the X's or whatever the O's. I don't know what we're calling it anymore. I still call it the Twitter. And I'm at the Ted Spread.
It's the X Twitter is what it is.
Aha.
See what I did there?
Yeah. I like it.
Ted Seifried, Zaner Ag Edge. Always good to have a conversation with you, buddy. And thanks for joining us on Market Talk today.
Pleasure's mine, Jesse. Thanks for having me, man.
And that's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.